A corporation may distribute cash to stockholders in the form of dividends. This video will explain how to account for cash dividends. A dividend is a distribution to stockholders on a pro rata basis, which simply means if you own 10% of the common shares, you will receive 10% of the dividend. The four types of dividends are cash, property, stock, or scrip. Cash dividends predominate in practice, although companies also declare stock dividends with some frequency. This video will focus on how to account for cash dividends, and a subsequent video will address stock dividends. Dividends are expressed as a percentage of the par or stated value, or as a dollar amount per share. For a corporation to pay a cash dividend, it must have retained earnings. Payment of dividends from retained earnings is legal in all states. It must also have adequate cash. And lastly, the board of directors must officially approve the dividend. As soon as it makes the declaration, it creates a liability. There are three important dates: the declaration date, the record date, and the payment date. On the declaration date, the board of directors announces the intention to pay the dividend. The declaration of a dividend creates an obligation or a liability for the corporation. The stockholders who own the stock on the date of record will receive the cash dividend. On the payment date, the company makes the dividend payment to the stockholders on record. Companies make accounting entries on the declaration and the payment date. No entry is required for the record date. To illustrate, let's assume that on December 1st, the directors of Media General declare a 50 cents per share cash dividend on 100,000 shares. The dividend is $50,000, and that is calculated by taking the 100,000 shares and multiplying that by 50 cents. In previous chapters, we used an account called dividends to record a cash dividend. Now we will use the more specific title cash dividends to differentiate from other types of dividends, such as stock dividends. The entry to record the declaration on December 1st results in a debit to cash dividends or retained earnings for $50,000 and a credit to dividends payable for the same amount. For your homework problems, use the cash dividends, not retained earnings, for recording dividend declarations. No entry is required on the record date. On the payment date, the company makes cash dividend payments to the stockholders and records the payment by debiting dividend payable for $50,000 and crediting cash for the same amount. Cash dividends cause a decrease in both assets and equity, or more specifically, retained earnings. This is a great exercise to practice recording cash dividend journal entries. The solution to this exercise will be provided in another document. Preferred stockholders have the right to share in the distribution of income before common stockholders. If the dividend rate on preferred stock is $5 per share, common shareholders cannot receive any dividends in the current year until preferred stockholders have received $5 per share. Preferred stock typically has a fixed dividend rate, which can be stated as a percentage of the par value or as a specified amount. Preferred stock often contains a cumulative dividend feature. This feature requires that preferred stockholders must be paid both current year dividends and any unpaid prior year dividends before common stockholders are paid dividends. When preferred stock is cumulative, preferred dividends not declared that were supposed to be declared in a given period are called dividends in arrears. If the preferred stock is non-cumulative Any dividends not declared in previous years are lost permanently. Most preferred stocks have preference on corporate assets if the corporation fails. This feature provides security for the preferred stockholders. The preference to assets may be for the par value of the shares or for a specified liquidating value. To illustrate the cumulative dividend, let's assume that this company has 5,000 shares of 7% $100 par value cumulative preferred stock outstanding. Each $100 share pays a $7 dividend, which is calculated by taking the dividend rate of 7% and multiplying that by par value. The annual dividend is $35,000, and that is calculated by taking the 5,000 shares outstanding and multiplying that by $7. If dividends are 2 years in arrears, preferred stockholders are entitled to receive the 2 years in arrears plus the current year dividend. No distribution can be made to the common stockholders until this company pays $105,000 to preferred stockholders. Dividends in arrears are not considered a liability. No obligation exists until the board of directors declare that the corporation will pay a dividend. Companies must disclose this amount in the notes to the financial statements. This is a great problem to practice the topics we have discussed so far. This problem is also similar to one of your homework problems. The solution to this problem will be provided in another document.